Welcome back to Inside Options with me, James Boardman. Tonight we're looking at option strategies, and we're going to look at some interesting graphics I've got here. So, what do all these have in common? A box, a condor high above the Andes, a butterfly, and a straddle. All of these are option strategies. They're all names that we use for option strategies, and strategies give you so much flexibility and elegance and sophistication in the way you can trade and you can express a particular view on a market. So let's look at some of these strategies. What I was talking about before was the overlay of strategy selection. So how do we choose what strategy we're going to do? Are we bullish on a stock? Are we bearish on a stock? Are we neutral? Now, although options are amazing tools, if you actually want to profit, you have to get your market outlook. You have to get your view right and then choose the correct strategy to trade that view. So that's strategy selection. And this poster actually helps you to do that. Extremely bearish, neutral, extremely bullish, mildly bullish. So what's important to see is how to read a profit diagram. So a profit diagram is just a payoff profile. It's what it will look like, what the options payoff will look like at expiry. So we can see there's a zero line going across profit or loss. That's the stock price at expiration. So from zero on the left-hand side to the far right is infinite high of stock price. Then the BEP, that's the break-even point. That's where your option strategy earns exactly the same amount as it costs you to put on. Above or below that point, you're making money. So strike price is then where the strikes are. You'll have an inflection point in your graph, and that's the different strikes you've got to combine. It's pretty simple when you have one option. When you have a bunch of options together, these pictures get a bit more complicated, and that's why you have to do them to understand the mechanics. The most simple thing, a long put. If you're bearish on the market, you could buy a long put on its own, and you could buy one put with a strike K. So let's say stock's trading at 100, you'd buy it at 90. Now you can see it's below the zero line because you've paid 7 Rand for that put. As the price declines, once it's fallen 7 Rand beneath 90, so to 83 Rand, you hit the break-even point, and then you can go right back up and you start making serious money above 83 Rand. But it takes a fall to 83 Rand for you to actually start making money. It's also got some other quite useful sort of little points on there that you can look at. There's a long call. So if you're bullish on the market, you could just buy a call. Once again, it has to move up substantially to meet your premium, and then above that, you're making pure profit. So now let's look at a specific example. We've got an option here on CFR, Compagnie Financière Richemont. So that's the old Richemont, and that is a really, really interesting stock because it's had some quite interesting moves recently, and there was some option open interest on it. And the guys who traded that did pretty well. So if we look at the price here on the 18th of April, you could buy a 40 Rand call. The futures price was trading at 38 Rand 87, and the call is just slightly out the money, so you're saying it's quite bullish. Now, that was valued at 129 Rand. On the 17th of May 2011, that same call was valued at 447 Rand. So the possible return there is something like 346% return. I put 246 because that's less what you paid to get into the strategy. So that's 246% return on your investment in 1 month between the 18th of April and the 17th of May. Now, the hedge fund who actually traded this traded on the 11th of April for 142 Rand, and they kept it till it expired. Now, it expired on the 15th of June because the 16th of June was a public holiday, so it was actually a Wednesday. So on the 15th of June, it expired at 202 Rand. So they'd made a 42% return in 3 months, in 3 short months. So that is phenomenal success. However, it's not the 246% return when I data mine through the various prices on each day to actually find when it would have been best to trade this. 246% return in 1 month. So if you thought it was a less great trade, you could do something like a bull call spread. Now, a bull call spread is when you buy one call, let's say you'd buy the 40 Rand call and you'd sell the 44 Rand call. Because you were pretty convinced it would be above 40 and you're pretty certain it wouldn't go above 44. So you'd sell one call and you'd buy another call. Now, by doing that, you managed to defray some of the costs you incur in doing a trade. So the example I looked at here, I think it was about 129 Rand and 29 Rand for the 44 call. Here you could do that on the 11th of April. You could buy the 40 Rand call at 129 Rand. and sell the 44 Rand call at 29 Rand. So that's an outlay of 100 Rand. On the 17th of May, the 40 Rand call was valued at 447 Rand, as we saw in the previous example. And then the 44 Rand call you sold was valued at 146 Rand. So that is a difference of 301 Rand, which is your profit on a 100 Rand investment. I mean, 300 Rand on a 100 Rand investment. So you'd actually get that 201% return on your investment, and you'd have a lower entry cost. So that could be a very viable option to look at, is using some sort of bull call spread for when you're bullish, or a put spread if you're bearish. Now, on the index, we've got a lot of quite liquid options on the ALSI, the top 40 index, on the futures there. And there you could trade a put spread. So it's quite amazing, because trading options, you've got all these amazing different opportunities. You can be long and short the market at the same time. You can trade a very nuanced view. Because of that, options are vital to have in your toolkit. You can be long and short the market at the same time by buying an out-the-money call, out-the-money put. So we really recommend looking into these option trading strategies some more, looking at the poster, and opening your eyes to a world of amazing opportunities, and being able to play the market like Yo-Yo Ma on a Stradivarius cello. So that's all for tonight. Thanks very much for watching. I'm James Boardman, and this was Inside Options.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.